Hello, everybody. At RatedA, we have our own methodology of how investing should work. But we don't just make calls here and there, tell you that this is undervalued or overvalued. We back everything we do with real money. And so we manage this portfolio here. We try to keep the amount of companies in the portfolio at around 20 or less. As of today, there's 17. But the main goal of this portfolio is just to beat the benchmark, to beat the S&P 500 and to beat the MSCI World Index. Depending on who you are and where you are, those two will most likely be the index that you compare yourself to. Now, a little caveat I will add to that is that beating the index is just not enough. If the index gets minus 50% over the course of the next 10 years, and we do minus 30%, yes, technically we are beating the index, but that's not a good investment result. So if we step back and try to actually pinpoint what the real goal of this portfolio is, it's not to outperform the benchmark, it's just to perform really well, to give us a return that we can be happy with, and that will allow us to reach our financial goals, which may take 20, 30 years, but we're guaranteed to get there. We started the portfolio in January of 2025. That's when all the moves that we make, all the buys and sells, and the composition of the portfolio has been 100% public. And so far, our result for the year is 27% as of the start of November. That's compared to 20% for the MSCI and 17% for the S&P. So far, the strategy is working, and the plan is that this will keep working in the same way year after year after year. Within the RatedA portfolio, we made a move in the last few weeks. We sold Oracle, a company that we had bought back in 2021, and that just got too overvalued, and we decided to make a change. If you want more details about why we made up our mind to sell Oracle, what was the straw that broke the camel's back, I'll let you click on the link that will appear on your screen right now. The question is what to do with the money from the sale of Oracle. At the end of the day, that's the problem with buying and selling and just increasing your activity in the stock market. Every time you sell, you have to find a good opportunity to replace that with. Otherwise, you'll just end up in cash and losing purchasing power to inflation. And given the fact that there are a limited amount of really good ideas in the stock market, it's not like you're going to find the perfect idea at the perfect valuation every single time that you have to sell one of your companies. So again, what to do with that money? We might have been persuaded to just fly to safety and keep that money in cash. Unless you're living under a rock, you'll have seen that every single news media outlet, even the most credible ones, are talking about an AI bubble. Even people that are not typically in the financial world are aware of this AI bubble. And then you have guys that are really responsible, really knowledgeable, that are within the investment space, that are coming out and for the first time saying that the market is overvalued, to be careful, very alarmist. For example, Aswath Damodaran, the Dean of Valuation, I just listened to a podcast that he did last week, and he's saying that he's starting to keep his money in cash and collectibles. The problem with a strategy like this is that you have to time the market, not once, but twice. You have to time your sell at the right time, and you have to time your re-entry into stocks at the right time as well. And then there's the issue that I personally hear all the time, which is what's happening with the market? Is the market too expensive? Is it time to sell the market? The point of investing is to make money. Unless you are trying to make money by buying the entire market, by buying an ETF or an index fund, then I would never worry about the market. You are never buying the market. There's always going to be some pockets of undervaluation in the market. There's going to be pockets of overvaluation, and the proportion of overvalued stocks to undervalued stocks might change over time. But you're very rarely going to be in a situation where every single possible investment in the world is overvalued. Even within the S&P 500, there's 500 companies. As an individual investor, as a stock picker, you can be picky, and that's the superpower of someone who picks their own stocks rather than buying an index fund. That's the entire point, is that you can control what you own, you can know what you own, and you can be picky. Charlie Munger is an investor that I admire. He gives a lot of very good lessons that every investor should know and memorize. One of them is that you should just make a list on a piece of paper and write down every single stupid thing that you can ever do to lose money in the market and just avoid doing those things. Well, in a similar vein, there are a few truths that I live by that are just going to improve my chances of doing well over time in the market. One of them is that stocks always outperform over the long term. People talk about gold, people talk about bonds, people talk about keeping your money in cash in order to preserve your capital, for example, against inflation. Well, I can tell you that the best way to fight off inflation is to own companies. Companies will be the first one to experience the cost associated to inflation when they have to buy new products, for example, or new materials, but they can very easily pass that on to the consumer. That's the whole point of owning a business. Companies can also reinvest to grow their own business. This is something that is quite unique about the stock market and about companies, is that they're the only asset class that can do this to mechanically grow your investment. It's not possible with gold, it's not possible with cash, it's not even possible with crypto or with real estate. There's a reason why stocks always outperform over the long term. The second truth that I try to live by is to never try to time the market. You might be right once or twice, and it might save you a few dozens of percentage points in any given year, but more often than not, you will end up on the losing side of that trade. The best way to win over the long term in the market is to own high quality companies, high growth companies, and buy them at a good valuation and just hold on to them over the long term. That is hands down the best way to become rich slowly, as Warren Buffett puts it. And that's what we do at RatedA. So when I sold a few weeks ago Oracle, the proceeds immediately went into another high quality companies that was selling at a fair valuation. And the goal is just to hold it for the very long term, touch it as least as possible so that it can compound on itself, and eventually one day sell it when it becomes egregiously overpriced. The company that I bought was none other than Booking Holdings, and in this video, I will be giving a little preview as to what are the characteristics that maybe want to own this company and why this company will surely outperform the market given enough time. So here we are on RatedA. This is a database I've created with all the companies that I cover, and the entire purpose is to cover as many stocks as possible of the highest quality possible. We do the qualitative analysis on the stock beforehand. What's the company's moat? What's the company's future growth prospects? What are the risks? And then we assign a rating to that company based on the quality. So this is a fixed rating that changes every year, once a year when the company reports its full year annual results. And for Booking Holdings, this quality rating is a B. A and B is usually what I consider a high quality company. D and F is what I would avoid at all times. And we'll get a bit into more detail about why I've given Booking these ratings, but for now, let's just take them as they are. Now, the main metric that I pay attention to whenever I make a buy or a sell is this value rating. The value rating is super important because it brings together two of the most important metrics whenever you are trying to get a good return on your investment. And that is the quality of the company and the multiple to free cash flow. Remember what I said earlier, that the best way to invest really well is to buy high quality companies for a good price. Now, what is a good price? Well, that will depend on the quality of the company. If the company is a shitco, it's really poorly run, it's going to see its cash flows decline year after year, well, a good price for that company would be very low. It would be a low multiple. Maybe you want to pay 2, 3, or 4 times free cash flow for that company. If the company, on the other hand, is extremely well positioned competitively, it's going to grow really quickly for a very long time into the distant future, then that's a very high quality company that you should be willing to pay more for because it's worth more. So that's the entire purpose of the value rating. It brings together the quality rating and the price of the stock. The reason why I bought Booking, as you can probably tell, is because the value rating is really high. Anything above 80 is considered a buy recommendation according to this system, and at the time of the purchase, Booking was trading above 80. So now let's get into why Booking Holdings deserves these quality ratings. Because at the end of the day, that's all the work that goes into creating the analysis for Booking. It's easy to just find a stock based on how cheap or expensive it is. But what's the hard part about investing is trying to figure out what multiple a company deserves, because every company is different and every company will have a different fair multiple. So, just a quick recap on what Booking does. They are a platform that connects travelers, customers basically, to hotels and other types of accommodations. In other words, it's a marketplace. Booking.com is the main platform, it's the most famous one, but they have a few others like Kayak, Priceline, etc. But by far the most important is Booking.com. And then in terms of presence, well, the most important region for Booking is Europe and a bit of Southeast Asia as well. Less so North America, that's more Expedia's playground. In the quality rating, you can see that the score for the Moat was a 4 out of 5. So why is that? First of all, Booking.com has massive network effects. Basically, textbook network effects with Booking. More customers means that more hotels will want to join the platform to get access to those customers. And more hotels on the platform means that customers will be more attracted to use Booking in order to have bigger choice. It's as simple as that. Network effects are really powerful, but they're very hard to get started. It's the chicken or the egg problem. Another characteristic of network effects is that they're winner takes all, usually. That's the whole point of having a network. And when it comes to these types of travel agencies, there's a reason why there's only three main competitors on the global stage. It's Expedia, it's Airbnb, and it's Booking. All the other ones, which is a ton of different agencies, are all a lot smaller. Now, I'm not going to go into massive details here, but all three, whether it's Airbnb, Expedia, or Booking, all have their different little niches, whether that's regionally or whether that's the type of customers that they target. If you want more information, a deeper dive on this, it's all on the RatedA platform. Now, the second important part of Booking's moat or its competitive advantage is switching costs. Because when you're a consumer or when you're a hotel, it's easy, supposedly, to change and to choose which platform you want to work with. It's the one that's going to give you the better prices. So if you're a consumer, you're going to go on Expedia first, check the prices, then you're going to go on Booking, check the prices, and essentially you'll book with the one that offers you the best deal. Booking is doing some things in order to prevent that dynamic from happening. The first is that they're offering loyalty programs. It's called Genius, and it gives you, as the customer, the incentive to stay and to be a loyal member on Booking. Because if you use Booking very often and you only book through Booking, no pun intended, you will get a lot of different offers, free breakfasts, and things like that. Little perks that make a difference when you're traveling. But then there's the other side of the transaction, the hotels, the accommodations. Why would they work with Booking and not another agency? The biggest factor here is the rating. Once a accommodation gets listed on Booking, starts getting reviews and gets rated by many people, and let's say that rating is good, then their incentive is to stay on that platform because that rating is going to bring them a lot of new customers. If they went to another agency, they would have to start the rating all over again, risk a lower rating, for example, and that might be a trouble when it comes to customer acquisition for them. The last big part of the moat is scale for Booking because Booking is by far the biggest player in the travel industry, way ahead of Airbnb and Expedia in terms of revenue that they generate. And so when it comes to advertising, and advertising is a huge part of this business, Booking can direct a smaller proportion of its revenues to advertising and still advertise more than its competitors. There's a reason why, if you're watching Netflix or if you're on TV or anywhere else, you're more likely to see an ad by Booking.com than by Expedia. It's just because they advertise more. Next, here on bookings analysis, we have a profitability of 5. This is technically a perfect score. Let me explain. The first thing here is if we have a look at the financials, we can clearly see that Booking is able to compound its revenue really quickly. Compound annual growth rate is on average more than 10%. So that's really, really huge. And if we scroll down, all the metrics are just up and to the right. The margins are really good. The company buys back its shares a ton. So obviously that improves the per share metrics, which means that your investment will compound more over time. And then here it is, the most important chart, the free cash flow per share is just beautiful. Apart for this drawdown here during the COVID years, and we'll get into that in just a second. The first point that's really important with Booking is that they switched the way that they make money basically in the past decade. They used to have an agency model where they connect the user to the hotel. And then once the user pays the hotel directly, Booking will receive a cut, a fee from the hotel at a later date. That's the agency model. Booking has been switching in recent years to a merchant model, which is now they still connect the user and the hotel, but Booking gets paid by the user. And then after the vacation, a few weeks later, Booking will send the money minus a transaction fee to the hotel. Now, this might seem like a minor difference, but it makes a huge, huge difference for Booking. And that is that Booking is now able to hold a ton of cash for a few weeks at a time and is able to essentially front run any types of investments it might have, etc. It's always better when a company has access to cash that's readily available, even if that's a short term liability. It just allows management to be very creative in the way that they use that cash. The next thing to mention here is AI. For a while, AI was seen as a disruptor for Booking and maybe a long term risk. Because what if you end up just putting your preferences in ChatGPT and it serves you up, the hotel that's best for you and you end up picking that option without necessarily going to a platform and looking through all the options? Well, it turns out that ChatGPT has now partnered with Booking. So that kind of throws that risk out the window. My perspective is that this will bring a lot more business to Booking in the long term. Another important factor for Booking's future growth is simply the regions in which it is present. Booking has a huge presence in Europe, which for a lot of the middle classes in the world is one of the top jet destinations. There's a lot of countries out there who have a rising middle class, and the first thing they will do when they have enough money to travel the world will be to go to France, to go to London, to go to Rome, all these classic iconic destinations in Europe. The other region that's super important for Booking is Southeast Asia, where Booking is also winning, because that is another destination globally where people tend to go. And like I was mentioning, a lot of these up and coming middle classes are in that portion of the world. And as soon as they have enough disposable income, most likely they will be traveling and discovering their own little region of the world. And just expanding on that theme a little bit, there's also the tailwind for Booking of secular travel growth. Every year, people travel by air more than the year before. Every year, people spend more on vacations than the year before. In part, that's because people are just getting more disposable income as areas around the world become richer. But another factor is that air travel is just becoming cheaper and more accessible. Finally, we move on to the safety metric here, which is the lowest out of the three, a 3 out of 5. The main thing to know here is that travel is a pretty precarious industry. It's easily disruptible. There's many different actors, many different things that need to go right in order for this industry to be alive and well. And every few years, there could be the risk of a big shock to the system, such as we saw in 2020. And at that moment in time, Booking would end up losing a lot of its revenue. But it's not just this type of issue. There's also government regulation. There's also populations in very touristic places, like we've seen in Spain recently, who rebel against tourists. At the end of the day, booking's business is really dependent on everything being smooth between different areas of the world, everything being open for travel. And as we know, the real world, it's not always the case. So that was pretty much a speed run of the entire analysis for booking. Again, if you want the deep dive version, it's all written out in the database and it's accessible. This same type of detailed analysis on the moat, the profitability, and the safety is available on over 60, 70 companies on the database, and it's just growing every single week. It's the perfect way to invest over the long term. You want to have an idea of which companies have the best ratings of quality and then be able to buy them when the stock price comes down. So the tradition in RatedA videos is we do a quick valuation at the end. When it comes to booking, I bought the shares at around 5,200. I assumed a revenue growth rate of 12% over the next 5 years, free cash flow margins of 30%, which is in line with what they have done historically, shares outstanding in 5 years of 29 million, which follows the trend again of the historical rates, a terminal multiple of 22, which is around where it's at today, so we're not assuming any multiple expansion, the current dividend growth rate of 8%, 100% of dividends reinvested, and we get a 16% CAGR over the next 5 years. This handily beats the market average, and this is why I've made my investment in Booking. The value rating never lies. Today, Booking is trading around 5,000, so you can even get a better deal than I did. Now, before I end this video, I just want to give a little disclaimer. I do own this company. Take everything I say with a grain of salt. This is not financial advice. And also, don't just buy a company because I did. I may sound very convincing, but this is a good investment for me. It might not be the same for you. You might have different needs, you might be of a different age, you might be at a different stage in your investment journey. And so, even if you use myself as one of your trusted sources of due diligence, definitely make sure you do your own due diligence before making any moves in the stock market. That's it for this video, and I'll see you in the next one.